Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I'm going to go to Twitter. I asked a question, we'll go over it here in a second. If you want to add me on Twitter, my name is at finding_finance if you want to do that. But let's go and attack one of the questions I had and what confuses people about investing. So the question is, what is something that still confuses you about investing? And some of the questions here, when to sell. Single most difficult decision time and time again. And I think that ties together with more than just a couple of these questions. What specific things to look for in a mining company? I know management is important. The metal they're looking at for is as well. Do you need to look at the financials of mining companies the way investors look at financials of Coke or Nvidia? How the paper market for commodities doesn't track the physical one. Actually, I don't. That still confuses me. I think they're trying to manipulate the markets. That's what I think. Because that just doesn't make any sense to me either. About the physical pricing versus the paper market pricing, and how the paper market is absolutely insanely larger than the physical market. And I think that in the future there's going to be a problem there. The problem is if you buy physical, the premiums are going to get ridiculous. And what I've seen throughout time is that the premiums continue to get larger and larger with time. I used to buy silver on special for 19 cents over spot, 19 cents an ounce. That was back. That was a ways back. And then, I was buying American Eagles for like $1.99 on special over spot when it was really low. I was buying it I think it was even $1.59. And I just kept buying and buying and buying and buying. And the premiums have continued to go up, which makes me think that the paper market and the physical market are disconnecting today. And that at some point, the physical will get this gigantic premium over the paper market. Now, that's something to talk about. That is something to talk about, because if you own the physical metals, which I bought when it was cheap. I just kept buying, guys. I'll be honest. And I think it ties into a couple of questions here. When things are cheap, I just pile into it. And the way that I hedge myself is through time. And if I position myself across a bunch of cheap assets that I know are cheap against other assets, I know that the money isn't there, I just hold on. If I have to hold on for 10 years, I don't care. And if someone says, well, I need to have a return right now, well, then you shouldn't be investing in its entirety. If you're looking for returns in weeks or months, you shouldn't be investing. You should go buy a business, develop a business, and go in that type of environment, because you won't see those returns. There's no sure way to get a return that quickly unless you just straight up take up gambling. I mean, that's really what it is. At that point, you're going to start trying to do short-term day trading or technical analysis, which then most of those people they don't make it. So if you're in investing, the one thing I've noticed with the differences between physical markets and commodities is that if you buy I'm talking mainly precious metals, if you buy physical metals, those premiums have not come down. I haven't seen them come down for years, over a decade. The premiums continue to go up. Usually they're a percentage of what the purchase price is. Maybe it's like, back in the day, this is a while back, 2, 3, 4, 5% of the price of the metal. So if let's just say it's $10 an ounce, right? It's like 4 or 5%. When I was buying silver, and it was very cheap at that time, they would run specials on APMEX and these other websites for like 39 cents over spot, 29 cents over spot, 19 cents over spot. And I would buy it because it's like, well, it's not because of the premium, but I would just buy it because I thought precious metals were a good store of value. I didn't know the ratios at that time as well. That was still early in the career or early in the investing research. And it wasn't as well known. But now, I mean, the premiums have gone just ridiculous. Now, is the premiums going to continue to get more ridiculous? That's really the question that I think we should be asking ourselves. So I think that the premiums are going to get worse. I think there's going to be a disconnect between the physical market and the commodity, the physical and the paper market. I think the paper market is going to be diluted to all get out. And I think the physical, we're going to get these massive premiums that just blows out. And the people who say, well, can I do this by buying, these ETFs? The ETFs follow the paper market. They don't follow the physical market. So you're buying a derivative of something that doesn't even follow the physical market. The physical market's starting to break from the derivatives market. So I don't know what the value of tracking a piece of paper is if the physical market completely separates from the derivative. So is it worth buying those ETFs? In my opinion, no, it's not. But, someone wants to hear the answer. They want me to say, yes, go ahead and do it. You can do it. Do whatever you want. I don't do it. I buy physical. I get my money out of the system and say, good luck. Because if you have problems in your currency system, those ETFs are going to track the paper markets. Who knows what the paper market's going to do? But I can tell you the physical market, if you run out of physical, you're going to see the largest divergence ever. I don't know if we're going to have a problem there. I think we will at some point, where the physical market becomes very short and there's going to be just gigantic premiums. I think the premiums will continue to grow with time. If they are manipulating the price, the premiums should continue to grow with time. And if we run into resource constraints in the future, over the next 10, 20 years, and I know that seems like a long time frame, it is, but I'm in it for the long term, I think we're going to see disconnects. I think currencies will fail. When? Don't know. And we're going to have to solve some issues. Maybe they don't fail. Maybe I'm wrong, which is fine. The biggest threat to all of this is an infinite amount of energy. If we can find an infinite energy source, then all of the ore grades, all of these things don't matter. If we don't have an infinite source of energy and we can't harness as much as we want, then ore grades matter infinitely. So really, that's really the play. You're when you buy precious metals, you're playing basically against that humans will not figure out an infinite energy source, because an infinite energy source means that any and all possibilities of all ore grades are now available. So that's really the bet, I guess, that you're making. And I don't think that's probably not within the next 10, 20 years is my guess, an infinite energy source, but it's out there and maybe we could figure it out, fusion. Coming up here, should we not be in the OTC stocks when the time to sell approaches? Is liquidity going to be shorthand us? Liquidity is a problem at the bottom of markets, not at the top of markets. We should be selling at the top of markets, not at the bottom. I've never had problems with liquidity at the top of markets. I've always had problems buying it. But maybe that's how I invest. And I try buying things when they're low, when nobody wants it. And when nobody wants it, that's when you have liquidity issues. That's where you got to get your limit buy orders in there, where you put in a limit buy order so it doesn't fill at some ridiculously high price. Why people invest alongside the Fed on the way up, but fight them when they go to southpaw? Because it's not fighting the Fed. The Fed is trying to slow the movement and momentum of inflation. And entire bull markets have happened when, like, gigantic moves, we're talking life-changing moves, have happened after the Fed starts to raise interest rates. So if you were to say that you're fighting the Fed, so the second that they start raising rates, you should just sell all your money and go to cash, well, you'd miss the entire bull market in oil, the entire bull market in uranium, the entire bull market of all of the good things in commodities where decades happen in years. That's the whole point of living with the volatility. The blow off top happens when the Fed doesn't raise rates anymore. When they basically raise, they start taking off and then they stop. That's usually when they do these blow off tops where they rotate money. Banks rotate money to retail, and retail chases it all. So you're not fighting the Fed. The Fed is fighting the momentum of inflation. And then the big blow-off moves start to come. Yeah, I talked about precious metals, paper price, setting my own buy, financial statements analysis. Now, getting into financial statement analysis, what I found is that you can find a company that's undervalued and it doesn't mean a thing. It doesn't mean a thing. Why does it not mean a thing? Because you have to have the money flows flow into it. That is what's important. It's not important that something's cheap. It's important that money eventually flows into whatever it is. You can stay cheap for a very, very, very long time. And if you've got infinite patience, Warren Buffett is very patient. But he chooses really boring companies, which is good. He chooses food companies or beverage companies or insurance companies, things that don't get designed out of its life. The life cycle's forever. It provides a service or a product that people will demand no matter what. And that's basically what he lives in. He lives in that type of area where the products don't go bad. They don't get, designed out, but they can be cheap and they have their time in the sun. It's basically value companies. What I usually do is I see the environment that the investments are in, and I try to get a little bit more leverage than a lot of those companies. I own some of those companies. Don't get me wrong. I own some and I still own them. United Health Group is one that I own for a very long time. But if you're going to play the interest rate game and you're going to play inflation and the more cyclical type companies, what you end up wanting to do is you want to invest in commodity type companies. You want to invest in precious metals because those are the ones that have all the leverage on the upside when it moves. And when the interest rates are high and they start to go back down, we get a crash, and then we go into that recovery phase where we have low interest rates, low inflation. Then it's tech companies because all of their growth is in the future, and it gets discounted at lower and lower interest rates, which pushes the valuations of those stocks higher. Value stocks work well kind of in any scenario. They just go really slow, which is good. And you should have some of those. What I've found is that the value companies, I just haven't really made much money from them. And some of them, I just didn't hold long enough. You have to hold them for a decade long plus. Something like a Chipotle, I thought, but that wasn't even a value company. It was a high PE ratio. I've never really found much success in value stocks. What I've found and what's worked for me the best are seeing companies that grow out in that you see, just people using it, and then investing in those companies. So my most successful investments on a long-term time frame is getting the market conditions right and then just choosing what's obvious to me. So what are some companies that are obvious to me? And this, you don't even have to look at the balance sheets, because if you look at the balance sheets, you're going to say this company is overvalued. The PE ratio, the price that you're paying for this, Buffett and all these guys would say it's overvalued. But all of those companies are the ones that I've made the most money on. I've made all my money on those. Chipotle was a great buy. Visa, MasterCard, Baidu, Google, Amazon. If Chick-fil-A was public, I'd buy Chick-fil-A in the right market conditions. And that's where I would make all my money. United Health Group, Anthem Blue Cross Blue Shield, everyone uses these things. And they're growing. The ones that are obscure and I've never heard of, I don't make money on them. Made money on Roku when the timing was right. I don't make money on the things that are, quote, value that I don't really know. I'd probably make money on PPG, the paint. I see that's used everywhere. Those are the companies I would buy. I wouldn't buy anything else. And the PE ratio and all that stuff doesn't even matter to me. If the market conditions are good and the money's going to flow into it, that's all that matters to me. The actual balance sheet is really hard to gain any sort of information from outside that they're not going to go bankrupt. You can have cash flows and whatnot, but you have to be in the right market conditions. They have to be in those market conditions where money's going to flow to those stocks. If they're in the wrong market conditions, the balance sheet doesn't matter. The money's not going to go there. So what basically happens when you start learning this game, and the game teaches you the game, so to speak, is that you realize that the financial statements aren't as important, at least in my opinion. They're important, but they're not as important as what I thought. Money flows in the market conditions is what is the most important thing, because that's where money wants to rotate and go to. A stock won't go up if money's not going to go there and buy it. It will not go up. So that was one of the things that I had to learn. And the market doesn't go when you want it to go. It's going to do its own thing on its own time. So the only thing that you can do is pad it with a bunch of time. You have to be super patient for it to play out. It may take a decade. It may take 5 years. It may take a year or two. No one knows. And all these people that claim that they know, they don't know either. And a lot of it does have to do with it's an entirely manipulated system through interest rates. Interest rates prices a lot of these assets. And the market conditions determines the interest rates. And the flows of money into and out of stocks and the valuations of those stocks. And what I've found, as weird as it sounds when I say it, is that the demographics of the United States determines the asset pricing of the entire world. It's that simple. Let's look at some of these other ones. And I know I still have the one of when to sell. Seems to me that investing today is playing what would the Fed do next guessing game. Nothing else truly matters. Well, they are printing a bunch of money and putting liquidity into the system, and they control interest rates. It is a rigged game. It is, to some extent. Confuses me is uranium's not at $150. Guys, it doesn't just moonshot. We're waiting for the money flows. We're waiting for money flows, and it takes patience. It takes patience. So when do you sell? When to sell? If you're in a company that controls its selling price, don't ever sell it. Just hold on to it. If it's something that doesn't get we'll call it designed out, don't sell it. That was my mistake, is selling some of these. I should have just held on forever. Visa, MasterCard, Chipotle, all those. I didn't hold long enough. I had them. I had entry points at $50 on Chipotle. CMG, what is it over? It's like 13 or 1400 now. It was over 1800. Just hold on to it. Why sell it? And the cyclical stuff, you're going to have to watch for leading indicators. The ratios get expensive. The PPI to CPI ratio starts to change in a direction that is unfavorable. You've got other ratios like commodity to stock ratio. That's when you sell, is when all those things start to rotate in an unfavorable way. When inventories get replenished and your production can sustain whatever the demand is, that is when it's over. That is when you sell. And it is literally that simple. A lot of people, what they do is they get scared by price movements. Price movements doesn't mean that you should sell. You have to look deeper than the price. The price is a symptom of something else. The root cause of most of these things are imbalances in the system. It's problems that aren't being solved. Money rotates to where problems are at. We have an energy problem. Money's going to rotate to it in a big way. Those problems haven't been solved. Does Germany have a solution for their natural gas problem? No. Are their inventories replenished? Do they have a line of sight on how they're going to get natural gas into that company? Have they solved their crisis problem? Are they putting in nuclear reactors? Are they extending their nuclear reactors? What's solving this on a worldwide scale? Do we have enough coal? Or do we have energy shortages in Asia? Yes. Are we going to have energy shortages in America? Probably. We have a lot of natural gas, but oil, I think, is going to be a problem at some point. The problems haven't been solved. Solutions haven't been put in place. The money will rotate to the problems. That is my take on it, at least. So would I sell? No, I wouldn't sell any of my energy. Now, if you have problems with energy, every time in history, what we've seen is we've had problems with currencies. They go kind of hand in hand. Now I'm talking market conditions, where money starts to rotate towards things. Does a balance sheet of something? Here's a question. I haven't seen a clear indication between a potential return and a balance sheet, just looking at a balance sheet. I have to look at the charts at some point. So I think that they're all interconnected. And I've valued more of ratios and market conditions over balance sheets. Balance sheets change when money comes and fixes a problem. Balance sheets change when the commodity goes up 10x. Believe me. Now, the question is which balance sheets change the most and which ones have good risk-reward profiles. That's what you get if you sign up with the Platinum membership with Finding Value. That's the Finding Value website in the description link, the Platinum membership. Those are the companies that I'm searching for, are which ones have that leverage to the price move. They'll just be a lot more volatile, though. That's the downside. So what I've found, I've found very little correlation with great financial balance sheets and trying to predict this stuff because I didn't have the market conditions right. You have to have the market conditions right. Money has to rotate to your investment. Otherwise, it will not go up. It'll sit there dead forever if no money's coming in it. You could have the best value in the world, but if it's out of favor, it's not going to do anything. That's probably the most important thing, in my opinion, to understand about investing is there is no way to get money quickly. You can get it by happenstance. You can be positioned correctly. You can see a good setup, and sometimes that setup doesn't work out. It does not work out sometimes. And sometimes it does. Sometimes it works out tremendously. But you better be in the stuff that has so much upside that it carries your portfolio upward with some sort of, you position size it correctly, and the upside is so large that it carries your whole portfolio with it. Eventually, if you're patient enough and you position well enough and the market conditions are right for these to, quote, grow in or go up in, then you'll get some. You'll get some that will do incredible things. But know that not everything will work. Not everything will work. We are playing with statistics and probabilities. We're not, someone can say that we've got this great setup and that we've got this huge market imbalance. And then people get impatient. They say, how come this isn't working right now? And I'll say, just wait. You're going to have to wait. The market doesn't move because you bought the stock. Doesn't work that way. You just have to be patient. You have to be patient. And some things don't work out. You have to realize that, know that, and that's why we take position sizes, and that's why we spread it out. Some things take a lot longer than what we want them to do. They may take 5 years or a decade. So that's kind of what I've learned over my investing is, it's a game of patience and basically taking money that you don't need and growing it to something that you can live off of at some point. That's really what it is. If this is money that you really, really need, it shouldn't be in the markets, especially if you need it in a short time frame. And that's kind of what I've learned over the years. So that's what I've got. I'll end it there. Thanks, guys, for participating and putting some questions in there. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And we'll catch you next time. This is Finding Value.